welcome to Wealth Forged. Go ahead and hit that like button, subscribe, and share this explainer, because today's topic could literally change your family's future. Look, grief is hands down one of the most difficult experiences any of us will ever have to go through. But compounding that emotional pain with sudden, crushing financial hardship, that's a reality no family should ever have to face. And while life insurance absolutely cannot replace a person, it is without a doubt the most effective tool we have to protect the family that person leaves behind.
Just imagine for a second losing someone you love deeply. And then, in the immediate aftermath, while you're just trying to process that immense loss, you suddenly discover you can no longer pay the mortgage, or the monthly bills, or childcare, or the future education expenses for your kids. It's an incredibly heavy thought, I know, but this is the devastating financial reality of a sudden loss without preparation. And unfortunately, it happens far too often. We really want to empower as many of you as possible with this crucial knowledge. So, if you find this breakdown helpful, please share this explainer with absolutely anyone you know who has a family to protect.
All right, so here is our roadmap for today's explainer. First, we're going to define exactly what life insurance is. Second, we'll explore why your family needs it. Third, we'll tackle the big term versus permanent coverage debate. Fourth, we'll figure out how much you actually need. And finally, we'll cover the massive mistakes you absolutely must avoid. Seriously, stick around for that last one, because it can save your family from a whole lot of unnecessary heartache.
Section 1. What is life insurance? Let's completely demystify this concept. At its core, life insurance is really just a contract between an individual and an insurance company. You, as the policyholder, pay premiums. If the insured person passes away while the policy is active and the claim is covered, the insurance company pays out what's called a death benefit to a named beneficiary. That is the whole mechanism. You're basically paying premiums to secure a highly protective financial payout.
So, what exactly is a beneficiary? Well, it's just the person, the people, a trust, or even an organization that you select to actually receive those policy proceeds. And here's a massive advantage you definitely need to know. In most ordinary situations, according to IRS guidance, the death benefits paid to a beneficiary are completely excluded from federal taxable income. Now, sure, exceptions can apply, and any interest earned might be taxable, but generally speaking, this is a totally tax-free financial lifeline.
Section 2. Why your family needs it.
When a loss occurs, the family essentially inherits specific financial burdens. The bills don't just stop. Life insurance steps right in to replace that lost income, keeping the lights on by paying the mortgage, the rent, and the utilities. It covers those sudden funeral and final expenses, clears out outstanding debts, and funds future education for your kids, but perhaps most importantly, and this gets overlooked all the time, it gives a surviving spouse the breathing room and the time to adjust financially without the immediate panic of bankruptcy. It can even be used to support a family business or leave a lasting financial legacy.
And this brilliantly illustrates a crucial point that so many families completely miss. Life insurance is not only for the primary wage earner. The unsung value of a stay-at-home parent is absolutely staggering. I mean, when you start factoring in the costs of childcare, transportation, cooking, and household management, services that suddenly become incredibly expensive to outsource, it becomes pretty obvious that stay-at-home parents absolutely need life insurance coverage too.
Section 3. Term versus permanent coverage.
Broadly speaking, there are two main categories you'll be looking at. On one side, we have term life insurance. This gives you temporary coverage for a specific period of time, usually something like 10, 20, or 30 years. If that term ends and the insured is still living, well, the coverage simply ends, unless you choose to renew or replace it. On the flip side, we have permanent life insurance. This includes things like whole life or universal life. This is designed to stay in effect for your entire life, assuming you pay the premiums, of course. And it can actually accumulate a cash value component over time.
So, what's the real difference? The crucial takeaway is that term life is usually way less expensive initially. It's super simple to understand, and it provides massive protection during those really important years when you're raising kids or aggressively paying off a mortgage. But it doesn't build any cash value, and renewing it later on, especially if your health has changed, can be pretty tough. Permanent life, on the other hand, gives you lifetime protection and can build cash value to support estate goals. The trade-off? It's usually much more expensive, it's more complicated, and doing things like taking out loans or making withdrawals can actually reduce your death benefit. That means policies like universal life require regular monitoring. There's honestly no single best policy for everyone. It really just depends entirely on your family's budget, health, and specific long-term goals.
Section 4. How much do you need?
So the first step to calculating your actual coverage need is addressing the immediate and long-term income gap.
You really have to ask yourself, how much income would the family lose, and just as importantly, for how many years would that income need to be replaced? For example, if you have a newborn, you might literally need to replace income for the next 18 to 20 years.
Next up, you got to look at the physical assets and liabilities. What debts would realistically remain? Exactly how much is still owed on the mortgage? You have to make sure there's enough funding to literally keep the roof over your family's head and keep the debt collectors at bay.
Then you need to project into the future. Are there children or other dependents? What could future childcare cost? What about college tuition? You also need to factor in how much money is already sitting there in your current savings and investments. The ultimate goal is to fully protect your dependents as they grow, right up to the point where they can finally support themselves.
Now, I know exactly what many of you are thinking right now. I have insurance through my job, so I'm totally covered. We need to dismantle this dangerous myth immediately. While employer coverage is a fantastic part of a broader protection plan, it is rarely enough on its own. It's usually limited to just 1 or 2 times your salary, and as we just talked about, that is not going to cover 18 years of income replacement. Plus, that protection almost always ends the very second you leave the job. If your health has changed by the time you leave, getting a new personally owned policy might be incredibly difficult or wildly expensive. You absolutely must evaluate your need for coverage outside of your workplace.
Section 5. Mistakes you must avoid.
Okay, please pay close attention to these critical pitfalls because they happen all the time. Number 1, waiting too long to apply. Your age and your health directly affect your price and eligibility, so don't delay. Number 2, buying coverage that is unaffordable. The absolute biggest tragedy is paying for a policy for years only to let it lapse because the premium was just too high, leaving your family unprotected when they actually need it most. Also, whatever you do, do not hide or misstate your health information on the application. And finally, do not keep the policy a secret. Your beneficiaries need to know the coverage exists and exactly where to find it. Fun fact though, the National Association of Insurance Commissioners does actually provide a free life insurance policy locator for families trying to find a deceased person's policy. But come on, you really shouldn't rely on your grieving family having to hunt it down.
You also need a rock-solid playbook for your beneficiaries. First, name a primary beneficiary. Second, always name a contingent or backup beneficiary. Third, you must review these designations after major life events, things like a marriage, a divorce, or the birth of a child. An outdated designation can create completely devastating legal problems for surviving relatives, because generally speaking, the beneficiary designation overrides your will. And fourth, avoid naming a minor directly without really understanding your specific state's laws regarding custodial or trust arrangements.
As we start to wrap up this explainer, I really want to reframe how we think about this whole topic. Life insurance is an act of financial preparation. It is not about expecting something bad to happen. The objective here isn't to be morbid. It's not about buying the largest, most complicated policy just to prove a point. The true objective is to shift your mindset from dreading the unknown over to empowerment. It's about getting suitable, understandable, and affordable protection, keeping it active, and making absolutely sure your family has a solid plan if life unexpectedly changes. So I want to leave you with this final provocative thought. If your income disappeared tomorrow, for how long could your family continue paying its regular expenses? Just let that sink in. Life insurance cannot remove grief, but it can absolutely prevent that grief from turning into an immediate financial crisis. I strongly encourage you to take action, consult a licensed professional, and secure your family's financial plan today. Thank you so much for hanging out with me on WealthForge for this explainer, and I will see you next time.